Welcome back, everyone. I'm going to talk to you about year-end tax planning moves that you should start thinking about now before it's too late. Many of these cannot be used after the year-end closes. So make sure to think about these and bring them to your CPA to see if they might work for you. This is not a complete list of all the opportunities that may be out there, but I also didn't want this to be an hour-plus long video. So I'm going to run through a lot of these very quickly. And if you need more information, please reference my other videos and do a deeper dive. The first item I wanted to talk about was think about whether there's any large purchases that you could make before year end. Now, I'm not suggesting to spend money solely for taxes. I'm talking about if you need something for your business anyway, doing it in 2023 may be a better timing rather than waiting until early next year. The first reason for this is because bonus depreciation, which allows you to write off a significant portion of the cost in the year you purchase it, rather than taking those deductions over a longer period using regular depreciation, will start to be reduced going into next year. This year, meaning 2023, you can write off 80% of the cost of qualifying assets. Going into 2024, that will be reduced down to 60%. The other item you should think about is Section 179. Which is somewhat similar to bonus, but it has some other rules that may make it less favorable than being able to take bonus depreciation. However, one benefit that 179 has over bonus for this year is that you may be able to write off 100% of the cost by utilizing it. However, the total dollar amount is limited to $1,160,000. Make sure you compare the eligibility of your asset purchases to see which one it qualifies for and which one may be better to use for this year. Next up, we have the pass-through entity tax. Hopefully your tax advisors talked to you about this. Essentially what happened was individuals were able to itemize their state taxes. So this included real estate taxes on your property. This included state income taxes that you would pay to the state that you reside in. This would also include potentially any vehicle license tax, taxes on investment houses or second homes, various amounts, and it was not limited to a dollar amount. However, starting with the 2017 Tax Cuts and Jobs Act, all of these were limited to $10,000. You might also see this referred to as the SALT limitation or the state and local tax limitation. Well, taxpayers and states got creative because they didn't want you to lose out on that benefit, so they created the pass-through entity tax regime. And essentially what this allows you to do in states that have this available, which is not all of them, but a significant amount of them do have this, and that is on your business income or income coming through on an entity return, so generally a partnership tax return or an S corporation tax return, you could elect to pay the tax on that income at the entity level. So typically partnerships and S corporations do not pay income tax because they are flow-through entities, meaning the income flows from the entity onto your individual tax return where you would pay the tax as an individual. However, if you make this election, you can pay the state tax at the entity level. This allows you to then take that deduction out of your business income so that it is no longer an itemized deduction and thereby escapes the $10,000 limitation. So if you have business income or you have income from an entity, maybe you sold real estate, the capital gain may be eligible. You'll have to check with your CPA and the specific rules in the state where that applies, but this can be a big tax saver. The next potential tax planning item has to do with the Inflation Reduction Act. The Inflation Reduction Act expanded and lengthened some of the credits that were previously available. It also upped some of those limits. The credits that I'm talking about here are for your principal residence, although there are also some for businesses as well or rental and investment properties. The first credit is the Energy Efficient Home Improvement Credit. This credit is for up to 30% of qualified home improvements. However, it is limited to $1,200 a year. If you're going to make improvements anyway to your home, make sure that you max out the $1,200 and maybe spread it into the next year if you're going to max it out and have more improvements so you don't get capped and you can take another $1,200 in 2024. There are some improvements that actually qualify for a higher credit of up to $2,000, so you'll want to check into those as well. The next credit is the Residential Clean Energy Credit. This is also for 30% of eligible costs. However, it doesn't have a low dollar amount limitation, which makes it more beneficial from that respect. This is essentially for energy improvements that regulate the temperature of your home. So think about your cooling and heating. This will be for improvements that use solar, wind, geothermal, biomass, or fuel cell energy to regulate the temperature of your home. Moving on, think about the timing of any large asset sales. If you have a lot of income for this year, you may want to push a sale into January instead of closing in December, assuming you have that opportunity. Alternatively, if you have deductions in 2023 that could be used to offset large sales, you might want to try and close those in the current year so that you can use those deductions against that income, because you may be limited on any carryovers going into the next year when you have those sales. So really, you just want to think about the timing of those sales and also any just deductions in general, deductions or income in general, whether there's any revenue you could defer or there's any expenses that you should accelerate into the current year. Moving right along, the Secure Act 2.0 was passed last holiday season, and this expanded a lot of credits. The Secure Act was all about retirement, making it easier for individuals to retire, trying to up the retirement amounts that people had, and also some benefits for those that are already retired. One of the big ones for employers that you should consider is the credit for setting up certain retirement plans. The government will actually give you up to $5,000 to set up a plan, which a lot of times will cover the entire cost of it. Additionally, if you make contributions as an employer on behalf of your employees, you can get a credit to offset those. In the current year, you can get 100% of those contributions up to certain dollar amounts covered. So essentially, you're able to pay your employees more, set up a retirement, potentially at no cost to you, and you can continue to get credits for funding on behalf of those employees for future years. The next one is a big one for S corporations and other companies that have their self-employment insurance running through the company, and that would be your health insurance reimbursements. So for an S corporation, if you are covering your health insurance, you want to make sure that that amount is included in your W-2 at the end of the year. So make sure to talk to your payroll provider and have that included. Otherwise, you can miss out on that deduction. There's also the Qualified Small Employer Health Reimbursement Arrangement. This allows you also to reimburse health insurance costs. You can do this out of other entities besides just an S corporation. This allows you to reimburse up to $5,850 for self-only coverage for 2023 and $11,800 if you have family coverage. Our next item has to do with gifting. If you want to gift items to get them out of your taxable estate, or you want to help support dependents or other people, you can give up to $17,000 away tax-free. It's tax-free to the person who is the recipient. It's also tax-free to you. Now, if you gift above that, you can reduce what is referred to as your lifetime exemption. And if you haven't gifted any amounts before, you may not owe tax depending on what those dollar amounts are. The lifetime exemption is relatively high right now, but many people will just give the maximum amount on an annual basis so that it has no effect on reducing that lifetime exemption. If you want to make charitable donations, also think about doing those before the end of the year. Generally, they're limited to 60% of your adjusted gross income, which is really all of your income less above the line deductions. So this would be like your self-employed health insurance and other items that are not itemized deductions. If you're giving to certain organizations like private foundations, those may have a lower threshold. So make sure to check with your CPA that you don't exceed those unless you intend to give those amounts and don't necessarily need the tax benefits this year. All right, lastly, let's talk about retirement moves. If you have a low income year, you may want to think about doing a Roth conversion, which means converting a traditional retirement account, which is taxable when you withdraw those funds, and putting it into a Roth retirement account, which instead will not be taxable when you withdraw those funds. This is generally a good idea when you have a lower income year, because when you make that conversion, it will be taxable at that time. That's how you get those proceeds tax-free later on. So try and accelerate other deductions or delay sales. And if you have low income, potentially do this Roth conversion. If you're an employee, or even if you're self-employed and you have a 401k, think about whether you should max out the 401k contributions this year to increase your deduction. And lastly, do not forget to take any required minimum distributions from retirement accounts if you're at that age, because there are penalties for not doing so. A lot of times people may forget this with everything else going on. I hope you found something in here that was helpful to you. Again, this is not everything, but this should hopefully jog your memory and give you some ideas to present to your CPA to start thinking about what you can do to lower your tax liability this year. I'll see you in the next video.